Hi, this is Jack Schwager. The Overbought Oversold indicator has two different applications. First, it can be used as a counter-trend index, which when it reaches extreme levels is a sign that you should be looking for a potential reversal or a sensitive condition to exit the trend position. For example, if the Overbought Oversold indicator had a very negative reading, then that would be a sign to be looking for a reversal to the upside. The second application is to actually use the Overbought Oversold indicator as a trend signal. Now, when the indicator just begins getting overbought, moving into low positive readings, it's often a good time to get positioned long. Similarly, as it just begins to get oversold, that is into negative territory, that is often a good time to get positioned short. So in effect, this approach uses the Overbought Oversold indicator in a contrarian fashion, that is, as a trend signal. First, let's look at the application of using the Overbought Oversold as an indicator rather than as the basis of trading signals. So in this particular example here, we have the Overbought Oversold superimposed over the corn market. We begin this chart with the indicator in positive territory. It moves into negative territory here, just begins to get negative, and then progressively gets more and more negative as the trend progresses. We don't get to extreme readings if, let's say, we define an extreme reading as minus 80 or less until this point, which is this price bar here, which is the first reading of the indicator below the minus 80 level, minus 82. And at that point, since we've reached what we define as a extreme reading, we would be more conditioned to look for a potential reversal in the market on the basis of the trend being fairly well developed. And so you could use any type of condition you want to define, but say we define a sensitive exit as being a close above a 5-day high, which is a pretty short-term minor signal. Then if you follow the market down, once we've got past the minus 80, the first time that occurs is this bar. And therefore, if you were using that application, you would get out of the market at this point, which is actually pretty close to the low. So that's an example of applying the indicator as a straight out indicator. We'll look at another example here, doing the same type of application for the crude oil market. Here crude's going from a sideways to a bear trend. You can see the Overbought Oversold going from positive to negative. The readings get increasingly negative as the trend progresses. In this particular case, if we're using again minus 80 as a condition for an extreme reading, well, that would occur first at this bar right here. Now, that's still well removed from anywhere near the lows that eventually occur. But again, this is not necessarily a bottom indicator. It's just a sign that the trend's well developed and you might want to look for a short-term condition or a sensitive condition to get out. If we use the same 5-day high in the case of the crude oil market for getting out a 5-day high close, in crude oil that does not occur until here. So again, you'd get out after a pretty good ride on the trend and a fairly good exit condition. The market, of course, eventually does end up going lower. There's no guarantee that that's going to be the absolute low, but it normally it would be a good relative, or might be a good relative exit condition. And also, even if you do get out here, of course, as the market goes sideways and breaks down again, you might well have reason to get back in. So it doesn't necessarily mean you would miss the rest of the move. The main point to take away from this is using it as an indicator is simply when you have a trend that goes far enough to get extreme readings in the Overbought Oversold, that can be used as a signal to be ready to get out on a minor reversal because the trend has already seen a large development. Now let's look at using the Overbought Oversold as a trend signal rather than as a counter-trend indicator as we just did. And the premise of that would be that when the Overbought Oversold just begins to get positive is often a good area to get long, and when it begins to get into low negative territory is often a good place to get short. That's the basic premise. So we define a signal in this example as the overbought oversold getting above the plus 10 level being a buy signal and below the minus 10 as being a sell signal. We come into the market here, corn, positioned long. The overbought oversold drops below plus 10, which gets us into neutral, as indicated by this yellow background. And then we drop down to minus 10, under minus 10, which gives us our sell signal. So we're going short right at this level here. We basically stay short the entire period. And when the overbought oversold gets back to the minus 10 level above it, we then have a signal to get out. We're into this neutral territory. And so we're exiting here, as indicated by the end of the reddish colored graph. So essentially that completes one short trade. We're then neutral until we get above the plus 10 level, which is here, or here on the price. We have a short-term trade, which ends up exiting when we break below the plus 10, which is here, giving us a short-term loss, and then back into neutral territory. So essentially over this entire period, we come in long. We have two additional trades, one good-sized one on the short side and a smaller, relatively smaller loss on the long side. So that's using the overbought oversold as a signal, as a trend signal. We can also do the same exercise and look at the other market we looked at before and see how it works in the crude oil. Here in crude oil, we're coming in again positioned long. We're using the same type of definition for buy and sells, namely plus 10 for a buy, minus 10 for a sell. And when we break below the upper portion, that's an indicator that there's a neutral territory. And so we're neutral until we get to minus 10, which is here. And that gets us basically short. And in this particular case, the indicator, of course, comes nowhere near the minus 10 level again, at least not for this period. And so as of this date, we're still in that one short trade. So here you basically have one trade long coming in and a new trade going short, which is still uncompleted. And that's another example of using the overbought oversold not as a counter trend indicator, but actually as a trend signal. So the bottom line is that you can use the overbought oversold either as a counter trend indicator or as the basis of a trend signal. The application is really up to you. So this completes video 3. In video 4, we'll take a close look at the directional weight indicator.